It is Thursday, January 22nd, 2026, and if you've been trying to make sense of the headlines this week, you are probably exhausted.
Oh, absolutely.
We've got this chaotic energy just radiating out of Davos. The president is suing the CEO of the country's largest bank for, what, $5 billion?
$5 billion. And we're yet again being promised that robotaxis are just around the corner.
It's been one of those weeks where the news cycle feels less like a stream and more like a fire hose aimed right at your face.
Exactly.
Which is precisely why we're here. For you, the learner, the person who wants to get the mechanism behind the headline, we are going to connect the dots.
And there really is a theme this week when you step back and look at it.
There is. The old structures, the safe bets we've all relied on for decades, whether that's NATO or the 30-year mortgage or even how software companies make money, they're all showing cracks.
We're seeing a world in flux. I mean, we're literally watching geopolitical borders get renegotiated in real time while the very definition of home and work is being rewritten for the consumer economy.
So our mission today is to dig right into that friction. We're going to look at the taco trade, which, despite the funny name, is terrifying investors. We'll explore why you might soon be putting your rent on a buy now, pay later plan, and explain why the stock market is suddenly terrified of AI, but not for the reason you might think.
And we have to talk about why Procter & Gamble is putting actual silk into diapers in China.
That one is my favorite weird economic indicator of the week.
Yeah.
But let's start at the top. The Davos download.
Right.
The markets rallied yesterday, breathing this huge sigh of relief because it looks like we avoided a massive trade war with Europe. But I don't know, looking at the details, I'm not sure avoided is the right word.
It feels more like postponed. Earlier in the week, markets just took a nosedive because President Trump threatened massive 10 to 25% tariffs on 8 European countries.
And then Wednesday, he just walks it back.
He walks it back. And this triggered a phenomenon that investors are actually calling the taco trade.
I saw this acronym floating around. TACO. It stands for Trump Always Chickens Out.
That is the literal term they're using on Wall Street.
But isn't that an incredibly dangerous bet to make? I mean, if the entire market is pricing in that the president is just bluffing to get leverage, and then one day he decides not to bluff.
Well, that's the catastrophic downside. That is the inherent risk.
Right.
The theory driving the taco trade is that he threatens these, economy-shaking levies to force a conversation. The markets panic, and then he pulls back to claim a deal and stabilize things.
Betting the bark is worse than the bite.
But you're right, if the bite ever actually happens, the market is completely mispriced.
Well, in this case, the reason he gave for walking back the tariffs is that he has a framework of a future deal regarding Greenland.
The Greenland obsession, yes.
It's been going on for weeks. The U.S. wants to buy it. Denmark says it's not for sale. So what is this framework that apparently stopped a trade war?
That is the billion-dollar question. Trump told reporters it's a concept of a deal. But if you look at the specifics he mentioned, it's not really just about land. He's talking about mineral rights and, crucially, the Golden Dome missile defense system.
Right, the Golden Dome. It sounds like something from a sci-fi novel, but this is all about Arctic strategy, isn't it?
Yeah, precisely. It's not a literal dome, but a comprehensive missile defense network. The Arctic is the shortest path for a missile traveling between, say, Russia and the U.S.
So controlling Greenland is controlling the high ground of the Northern Hemisphere.
That's the strategic thinking. So the U.S. sees this as an existential security necessity. But here's a conflict. Greenland's Prime Minister, Jens Frederik Nielsen, came right out and said he doesn't know the details of this concept, but sovereignty is a hard red line.
And the Danish Prime Minister, Mette Frederiksen, she backed him up completely.
She did. She said they're open to security talks, which, that plays into the missile defense angle, but selling the island, non-negotiable.
So we have a situation where the U.S. president is claiming a deal to save face on tariffs. And the Danes are saying, we can talk about radar, but we're not selling the country.
It's a fragile piece, to say the least.
It really feels like the old alliances are fracturing. And speaking of fractures, the other big story out of Davos was this board of peace for Gaza.
Right.
Trump signed the charter, along with the UAE, Pakistan, Hungary, Argentina. But looking at that list, it's not who is there that matters, it's who isn't.
You notice the gap. The traditional European powers, France, Germany, the UK, Italy, they were either absent or they rejected the invitation outright.
And the UK specifically cited concerns because Vladimir Putin was invited.
Exactly. So that is a massive shift. You have the U.S. building this new coalition that includes Russia and Hungary, while completely bypassing the traditional NATO core.
It signals a move toward a much more transactional foreign policy.
Absolutely. Less based on shared values or historical alliances. And Ukrainian President Volodymyr Zelensky clearly sees the writing on the wall.
His speech at Davos was scathing. I mean, he didn't just ask for money. He basically called Europe lost.
He was incredibly blunt. His whole argument was that Europe is wasting time trying to change Trump or trying to convince him to care about the old order. Zelensky's telling them, stop looking to the U.S. to save you. Unite and defend yourselves.
He even called out the U.S. troop presence in Greenland, right?
He did. He pointed out there are only, 30 or 40 soldiers there?
A tiny number.
And he used it to make a point. 40 soldiers is not a military deterrent against Russia or China. It's a gesture. He's mocking the performative nature of these security guarantees and demanding real hard power.
It's a stark warning. But let's bring this theme of conflict home. If the White House versus Europe is tense, the White House versus Wall Street is getting litigious.
Litigious is a good word for it.
We have a sitting president suing J.P. Morgan Chase and Jamie Dimon for $5 billion.
This is historically unprecedented. I mean, you usually see the government suing banks for fraud or mismanagement. This is a personal lawsuit from the president alleging political debanking.
And the claim is that after January 6, 2021, Chase closed accounts belonging to Trump and his companies specifically because of woke beliefs and political discrimination.
Yes, he's framing it as a targeted attack on his civil liberties. Now, J.P. Morgan's side of the story is that this was strictly regulatory and risk compliance standard know your customer stuff.
But you can't ignore the context.
You can't. Jamie Dimon was at Davos this week openly criticizing Trump's immigration policy. He even referenced those videos of ICE officers.
I heard that clip. He said, I don't like what I'm seeing, describing 5 grown men beating up women.
So you have the CEO of the most important bank in the world openly sparring with the president on moral grounds while the president is suing him for $5 billion.
If you're an investor, you have to be asking, what does this do to financial stability? If the government is at war with the banking sector, that introduces a level of systemic risk we just aren't used to.
And yet, and this is the crazy part, if you look at the macro numbers, the economy doesn't seem to care about the drama.
It's just chugging along. Q3 GDP was up 4.4%. That's a boom time number.
It is, but we have this persistent itch with inflation. The November PCE, which is the Personal Consumption Expenditures Index, came in at 2.8%.
And just to clarify for everyone, the Fed prefers PCE over CPI because it tracks what people actually buy when prices go up. So like switching from beef to chicken.
Exactly. It's a more accurate measure of consumer pain. And 2.8% is still well above the Fed's 2% target. So prices are still rising faster than they were. However, we did get a win for the onshoring crowd this week.
GM, they confirmed they're moving production of a Buick compact SUV from China to Kansas City starting in 2028.
The Fairfax assembly plant. And they explicitly cited pressure from Trump and the threat of tariffs. So going back to the taco trade, even if the president chickens out on the actual tariffs, the threat is clearly enough to move corporate strategy.
It proves that uncertainty itself is a policy tool. Now, speaking of uncertainty, I want to pivot to how all this economic pressure is reshaping our actual lives. We've talked about borders changing, but the way we use real estate both for work and living is undergoing a massive evolution.
The office market is the clearest example. Traditional leases are dying, but flex office is absolutely exploding.
I was looking at the numbers for Industrious. They're a flex office provider owned by CBRE. They grew their footprint by 58% in 2025.
58%.
That's astronomical growth for a mature market like real estate.
It tells us that the whole return to office mandate didn't result in everyone going back to a cubicle from 9 to 5. Companies want headquarters quality experiences for their satellite workers, but they refuse to sign a 10-year lease.
It's the asset-light model.
Exactly. Industrious shares profits with landlords rather than paying fixed rent. It spreads the risk. But this flexibility mindset is now bleeding into the residential market in a way that I find a little concerning.
You're talking about buy now, pay later for rent.
Yes. A firm is partnering with a company called Isuzu. They're offering a product where you can split your monthly rent into bi-weekly payments with 0% interest.
Okay, let me play devil's advocate here for a second. Cash flow is tight for a lot of people. Most people get paid bi-weekly. So splitting the rent to match your paycheck seems like a helpful tool to avoid late fees.
In a vacuum, sure, it helps with liquidity. But zoom out. If a significant portion of the population needs a financing product just to pay for their housing, that signals a fundamental affordability crisis. It turns a fixed cost of living into a managed debt product. It's the financialization of the roof over your head.
It feels like a slippery slope towards subscription living. You don't own the home, and now you don't even really pay the rent in a traditional sense. You manage the payments.
And retailers are seeing this shift. Look at Lowe's. Historically, Lowe's is where you go to buy lumber to build a deck on the house you own.
Right.
But they're totally pivoting their strategy because the median age of a first-time homebuyer has hit 40.
That number blew my mind. 40 years old.
So Lowe's can't wait for millennials to buy homes anymore. They're targeting Gen Z renters with what they call dopamine products.
Pink buckets and viral TikTok items.
Exactly. Small, affordable hits of consumer joy because the big purchase, the house, is out of reach. They're even relaunching kids' workshops to build brand loyalty with the children of millennials, hoping to catch them 2 decades early.
Wow. Adapting to a generation that might be renting forever. And for some, the solution is just to opt out of the U.S. market entirely. We saw that viral story about the American expat in Bahrain.
The 30-year-old paying $2,200 a month for a 3-bedroom house with a pool and domestic staff.
Which would get you, what, a damp studio in New York City?
Yeah. If you're lucky, this highlights the geo-arbitrage trend. If you can work remotely, why pay first-world prices? People are migrating to lower-cost living countries just to recapture the quality of life they can't afford in America.
Okay, we have to talk about the diapers. We mentioned P&G is putting silk fibers in diapers in China. This seems ridiculous on the surface, but you said there's a deep economic signal here.
It is a textbook case of premiumization as a hedge against a demographic collapse.
Break that down for us.
Okay, so China's birth rate has hit a record low. The sheer volume of babies is shrinking, and shrinking rapidly. For a company like P&G, that's a disaster. If you sell fewer diapers, your revenue tanks. Unless you can charge way more for each diaper.
So because there are fewer babies, parents have more money to spend on the one kid they do have.
Precisely. It's the little emperor syndrome. So P&G creates Pampers Prestige with silk. They charge a massive premium, and they maintain their revenue growth even as the market size shrinks. It's brilliant and also a little dystopian.
From geopolitics to silk diapers, the thread is companies and countries scrambling to adapt to a shrinking, shifting world.
Adaptation is the only survival strategy right now.
Which brings us to the sector that usually drives the most change: tech. Something strange is happening. While Elon Musk is out making bold promises again, the software industry is facing an existential crisis.
Let's start with Musk. He was at Davos claiming Tesla robotaxis will be widespread in the U.S. by the end of 2026.
I feel like we need a fact check on the timeline here. He promised 1 million robotaxis by 2020. Then he promised 500 in Austin by 2025.
And the actual number in Austin was about 60? Meanwhile, Waymo just launched in Miami. So while Musk dominates the headline, his competitors are dominating the actual road.
Right.
But the bigger story in tech isn't hardware. It's the collapse of software stocks. Salesforce, Adobe, ServiceNow, these giants are taking a beating.
And this connects to AI, but maybe not in the way people expect. It's about AI agents, right?
This is the crucial insight. For the last 20 years, the business model of software has been SaaS, software as a service. You pay for seats. If you have 100 employees, you buy 100 licenses of Salesforce.
Right. It's basically a headcount tax.
But now we have AI agents like Anthropic's Claude that can autonomously execute tasks. So if an AI agent can do the work of 10 junior employees, the company just doesn't need to hire those 10 people.
And if they don't hire those 10 people, they don't buy 10 Salesforce licenses.
Exactly. The fear is that AI agents will destroy the seat-based revenue model. If AI does the work, the software companies lose their biggest revenue multiplier, human users. That is why investors are fleeing the sector.
It's a total paradigm shift. The tool that was supposed to make us more productive is actually destroying the business model of the tool makers themselves.
However, smart money sees an opportunity here. Private equity firms like Thoma Bravo are looking at this sell-off and buying the dip. They believe the market is overreacting and that software will evolve, not die.
They're prepping for a big year of M&A.
A massive year. And meanwhile, Intel, the company everyone wrote off, is surging.
Because when the software world is melting down, investors retreat to what's real.
What's real? Intel makes chips. Domestic foundries, government backing. It ties right back to that GM, story manufacturing, and physical security are back in vogue.
So to wrap this all up, we've covered the taco trade and the risk of calling the president's bluff. We've looked at the fracturing of NATO and the new Board of Peace. We've seen how rising costs are pushing us toward buy now, pay later rent, and how AI is threatening to upend the entire software economy.
The common denominator in all of it is the breakdown of the default settings. The default alliance, the default mortgage, the default software license, they're all being challenged simultaneously.
It feels like we're moving toward an economy of ultimate flexibility. Flex office, flex rent, flex geopolitical treaties. But the cost of that flexibility is stability.
That is the trade-off. We are trading certainty for optionality.
I want to leave you with a provocative thought to mull over this week. We talked about AI agents replacing seats in software. If we're moving toward a world where you subscribe to your housing, and an AI agent can replace the white-collar job that pays for that subscription, what do you actually have? Are we building a future of ultimate convenience or ultimate vulnerability?
And on a lighter note regarding Greenland, if a deal ever does happen, does the purchase price include the 40 soldiers stationed there?
That is a question for the negotiators. Thanks for listening to The Deep Dive. We'll keep watching the world spin so you don't have to. See you next time.